Right now, the market is pricing in a 38% chance that the Federal Reserve does something completely unexpected this week.
Yeah, 38%,
Yeah.
which is wild.
It's terrifying, honestly. If you spend any time watching the Fed, you know that number is just a massive red flag. Normally, going into a meeting, the market has it priced at a 0% chance of a surprise, right?
No.
Or it's near 100% certainty of a telegraphed move.
Exactly. They like to broadcast what they're doing. So a 38% probability means the bond market basically has absolutely no idea what is about to happen.
Right.
It means we're flying blind into one of the most consequential weeks of the year.
Welcome to this deep dive. Today, our mission is highly specific. We've got this massive stack of market analysis, economic data, earnings reports, and we're going to extract the most critical, actionable trading insights from all of it.
Because we are heading into a profoundly tense environment right now.
Yeah, we really are. We have that highly unpredictable Fed meeting colliding with mega-cap tech earnings, and it's all dropping simultaneously.
And look, for anyone managing capital right now, it feels chaotic. I get it. But understanding the hidden currents beneath that chaos, the unusual volume, the specific price action anomalies, and exactly what the smart money is positioning for.
That's your ultimate edge.
Right, that is the edge. We're going to bypass the mainstream noise today and focus entirely on the mechanics of what's moving the market and the actual technical levels you need on your screen.
Exactly. But before we even look at a single stock chart or crypto setup, we have to understand the invisible force that is currently suffocating the broader market. The cost of capital is rising rapidly.
So rapidly.
I mean, we're looking at global investment-grade government bond yields surging to 3.68%.
Which is the highest level we've seen since the 2008 financial crisis. Let that sink in.
Wow.
Yeah. And if you look specifically at the U.S. 10-year yield, it has pushed up to between 4.68 and 4.71%. That's a 20-month high.
So let's look at the mechanism here. What is actually driving that massive spike? Because the sources point to two converging factors, right? You have structurally elevated global nominal GDP growth on one side and deeply depressed global savings on the other.
Yes.
Break that down for us. How did those two things interact to force yields so high?
Well, it really comes down to the basic supply and demand for money. Let's look at the demand side first. Global nominal GDP growth in the first quarter came in at 6.7%.
Okay.
And to put that in perspective, the historical trend prior to 2020 was hovering between like 4.9 and 6%. So economic activity, the demand for capital to fund businesses and expansion and spending, it's running extremely hot.
Right, so very high demand for capital.
Exactly. But then you look at the supply side, which is global savings. The growth rate of global savings is currently among the lowest on record.
Oh, wow.
Yeah. The supply of capital is deteriorating. So you have a massive global economy demanding cash and a shrinking pool of savings to actually fund it. And I mean, when supply is low and demand is high, the price goes up.
Basic economics.
Right. And in the financial system, the price of money is the yield. Borrowers, and that includes governments, they have to offer higher and higher yields to attract what little savings are actually out there.
And the sources are raising massive red flags about this dynamic, specifically warning about a 1998-style correction. Now, for anyone listening who wasn't trading back in the late 90s, what happened in 1998, and why is that the parallel being drawn today?
So 1998 was the long-term capital management crisis, or LTCM.
Right, the famous hedge fund blowup.
Exactly. LTCM was this massive hedge fund run by actual Nobel laureates, and they used incredible amounts of leverage to make highly complex trades. They basically assumed certain market conditions, like the cost of debt and the spread between different bonds, would remain stable.
But they didn't.
No, they didn't.
No.
When Russia suddenly defaulted on its debt, risk premiums spiked globally. Liquidity just dried up overnight.
Because everyone suddenly rushed to safe assets and just stopped lending entirely.
Exactly. Everyone panicked. And because institutional investors like LTCM were so overextended, that sudden increase in the cost of capital blew them up. It nearly took the entire global financial system down with them.
Right.
So the parallel today is that we have overextended institutional investors operating in an environment where the cost of equity and debt is technically sitting below its long-run average, but those global savings are shrinking.
So if the market suddenly demands a higher risk premium,
Right, a higher return for lending money, the shock to these highly leveraged portfolios could trigger a severe cascading summer correction.
which brings us back to that terrifying 38% number we started with. Sitting right in the middle of this structural powder keg is the upcoming Federal Reserve meeting under Kevin Warsh. The sources describe this as just a total black box.
A complete black box. There is zero forward guidance.
None. There are no media leaks, nothing.
And that lack of communication is exactly what's rattling the bond market. The Fed currently has 12 independent voters, and based on the limited data we have, they seem heavily fractured.
I mean, you have energy prices running hot, inflation stubbornly sitting above 3%, and a Fed chair in Warsh who refuses to telegraph his punches.
It's a tough spot. If they hike, they shock the equity market. If they don't hike and inflation keeps running, bond investors might completely lose faith in the Fed's resolve.
And that would trigger a massive sell-off in bonds, sending those yields soaring even higher, right?
Exactly. So we're navigating this landscape where the cost of capital is both incredibly high and dangerously uncertain.
Yeah. And Jim Bianco had a framing for this in the sources that he calls the 456 market. He frames it as a reality check for a generation of traders who basically treat 20% annual returns as a baseline expectation.
Oh yeah, it's a stark mathematical reality check. Historically, the real return of the stock market, meaning your return after you subtract inflation, is only about 3%.
Just 3%.
Right. And Bianco points out that we're entering an environment where capital allocation looks very different. You can expect roughly a 4% return simply sitting in cash. You can get a 5% return on bonds. And he projects roughly a 6% return on non-AI equities.
And the detail that really stands out here is about TIPS, Treasury inflation-protected securities. The sources note they're currently offering a guaranteed 3% real return.
Which is huge. That means you can lock in the historical inflation-adjusted average of the entire stock market. But with zero equity risk, it is guaranteed by the government.
Okay, I'm going to push back on this, though, because I know exactly what you're thinking as a trader listening to this.
Okay, let's hear it.
If I'm looking at tech stocks that have been pulling down 15, 20, or even 30% in a year, why would I, or any institutional manager looking for alpha, lock up capital for a guaranteed 3% in TIPS? I mean, a 6% expectation on stocks might make sense for a legacy consumer brand, but surely that doesn't apply to the tech giants actually driving the modern economy.
See, that pushback cuts right to the heart of what's happening. Your instincts are completely right, but they highlight this massive structural fracture in the market.
What do you mean?
Well, the stock market is no longer functioning as one cohesive entity. It has essentially split into two distinct, negatively correlated asset classes, AI and non-AI.
Wow. Okay, and the concentration numbers in the sources are just staggering. AI-related stocks, which is a basket of just 41 companies, now make up roughly 45% of the entire S&P 500's weight.
Think about that.
41 companies are 45% of the index, and the other 459 companies make up the remaining 55%.
You literally have to go back to the late 19th century when railroads dominated like 70% of the stock market to see this level of concentration.
That's insane.
And the crucial detail is that the correlation between these two baskets has turned negative.
Meaning what exactly?
When the AI stocks surge, they are sucking liquidity out of the other 459 companies, pushing them down, and vice versa.
It's a seesaw. So what is fueling that AI side of the seesaw? It's this capital expenditure supercycle that is almost difficult to comprehend. AMD CEO Lisa Su is projecting the AI accelerator market will hit $1.4 trillion by 2030.
Trillion, with a T.
Yeah. AMD just dropped a $5 billion investment into Anthropic. Google is massively accelerating its CapEx, aiming for a $200 billion midpoint for the full year of 2026 alone.
But here is where traders need to pay incredibly close attention, because the underlying psychology of the market is shifting in real time.
Also,
The smart money is starting to look at that 5% cost of capital we just talked about, and they're doing the math. The market is beginning to aggressively punish companies for massive speculative AI spending, and they are actively rewarding the cash hoarders.
let's get into the mechanics of that because the recent earnings data perfectly illustrates this shift. Google reported negative free cash flow, largely driven by these massive AI infrastructure investments. And the market didn't like it.
Nope, they hated it.
Then Intel reported a massive $2.16 per share loss. Now, the sources note a really important technicality here. Intel's loss was heavily tied to derivative liabilities from the U.S. government's GPS Act. Can you explain how that actually works? Because, frankly, it sounds like accounting jargon.
It is an accounting quirk, but it's a vital one to understand.
Okay.
So when Intel secured funding through the GPS Act, it involved giving the government warrants or escrowed shares. Under accounting rules, those instruments are treated as derivative liabilities.
Meaning what exactly?
It means if Intel's stock price goes up, the value of what they theoretically owe the government effectively goes up. They have to remeasure that liability on their balance sheet every quarter, which creates a paper loss.
Ah, I see.
Yeah, it's not a loss from their actual business operations. They didn't lose that cash selling chips.
Right. Intel's underlying operating quarter was actually profitable.
Exactly. But the market punished them ruthlessly anyway.
Why? If it's just a paper loss?
Because patience for complex, capital-intensive narratives is just evaporating. In a world where money costs 5%, investors don't want to hear about derivative liabilities and multi-year data center build-outs. They want to see cold, hard cash today.
Which perfectly explains the contrast with Apple. Apple just experienced this massive stock rally, and the sources attribute it to the fact that Apple is notoriously not spending heavily on AI capex.
Exactly.
They are going into negative free cash flow to build tens of billions of dollars in new infrastructure. They're letting others spend the money while they just sit on mountains of cash.
And printing cash today is suddenly the most attractive fundamental metric in a high-yield environment.
Now, there's a fascinating tactical detail hidden in Google's press release regarding this massive capex build-out. Google admitted they're using third-party neoclouds as what they call a bridging strategy due to supply constraints. Explain what a neocloud is and how this bridging strategy actually functions.
Think of a neocloud as an independent, highly specialized data center that basically managed to buy up a ton of NVIDIA GPUs early on.
Okay, so they have the hardware.
Right, and hyperscalers like Google and Meta are desperate for computing power to train their models right now. But building a massive proprietary data center takes years. I mean, you have to secure the land, the permits, the massive power grid connections, and the actual chips.
So while they're building their own infrastructure, they are renting capacity from these smaller neoclouds.
Exactly. It's a bridging strategy.
It sounds like a major airline desperately needing to keep its routes open, so it rents a fleet of expensive private jets while it waits 3 years for Boeing to deliver its own planes.
That is a perfect analogy. It gets the job done, but it is wildly expensive. Google noted this will create near-term margin pressure because renting from third parties comes at a massive premium.
And this reveals a brilliant play by the smart money. Because the insiders at these neocloud companies, they know exactly what's happening.
Well, they know.
They know this rental income is a temporary windfall. Once Google and Meta finish building their own massive data centers, they're going to terminate those rental contracts immediately.
Which is why the sources show insiders at these third-party neocloud companies aggressively cashing out right now.
Right.
They're utilizing share-based compensation to dump their stock on retail investors at peak valuations, locking in their profits before the hyperscalers inevitably abandon them.
Okay, so we've established the macro pressure from yields, and we've unpacked this massive rotation away from AI capex burners toward cash-generating giants. If you're a trader, how does this actually manifest on the charts this week? Let's move to the trading desk and look at some critical price anomalies and actionable levels.
Let's start with a glaring anomaly that occurred over the weekend because it really speaks to massive institutional positioning happening behind the scenes.
Yeah, this was crazy.
On the offshore crypto exchange Hyperliquid, crude oil futures experienced a violent, inexplicable plunge. At Friday's close, crude was sitting at $90.48. Over the weekend, with absolutely no new geopolitical developments or supply data to trigger it, the price plummeted to $85.18.
A drop of more than $5 on an illiquid weekend session. I mean, that doesn't just happen randomly.
No, it doesn't. And the market speculation highlighted in the sources is that this massive move might be driven by smart money front-running anticipated U.S. political policy shifts.
Interesting.
Specifically, there are heavy rumors that Donald Trump's inner circle is closing out long oil positions and establishing massive short positions ahead of a potential policy announcement regarding energy production.
And it is crucial to state right here, we're looking at this purely through the lens of market mechanics.
Yeah.
We are entirely impartial regarding the politics, of course.
Absolutely.
But as a trader, you cannot ignore a $5 drop on an offshore exchange. The mechanism of front-running on offshore platforms, that's a classic way for deep-pocketed players to get ahead of the news cycle without triggering the immediate regulatory flags of domestic exchanges.
Exactly.
If you're touching oil this week, you basically have to operate under the assumption that a massive, well-capitalized short position has already been established.
Right. Follow the volume.
Yep.
Respect the tape. Now let's look at the equity indices because the actionable levels we're watching are incredibly fragile.
The S&P 500 has been drastically outperforming the tech-heavy Nasdaq-Q.
Yeah.
What is this specific line in the sand for the S&P?
For the S&P, the absolutely critical zone is 7496 to 7504. That represents the highs we saw on Friday.
Okay, so 7496.
If the S&P can defend that level and base above it, the bullish thesis remains intact. But if it fails to hold 7496, the technical structure breaks down, and the chart indicates a rapid gap fill all the way down to 7400.
And for anyone newer to technical analysis, a gap fill means there's an area on the chart where the price previously jumped up so quickly that no trading actually occurred at those intermediate prices.
Right.
So if it falls back into that zone, there is no historical support, no previous buyers at those levels, so the price just tends to plummet straight through it until it hits the bottom of the gap.
Precisely. It acts like a vacuum, so 7496 is your pivot point. Meanwhile, the Nasdaq is in a much weaker posture. It absolutely must reclaim the 22 BF5 2900 740 level.
And it's struggling there.
It's currently acting as heavy resistance. If the Nasdaq cannot push through that ceiling, the momentum will likely fade, dragging it down to the next support level at 284.30.
What about the QQQ ETF, which tracks the Nasdaq 100? What are traders watching there?
The QQQ has formed a quadruple bottom on the daily chart, right at the 686 to 687 level.
Let's explain the psychology of a quadruple bottom because it's a massive technical event.
Yeah, a quadruple bottom means the prices dropped to that exact 686 level 4 separate times, and every single time, buyers have rushed in to prop it up.
It establishes a massive psychological floor.
It does. But it also means that every buyer who bought at that level has placed their stop-loss orders just beneath it.
Huh.
If the price breaks through 686, all of those stop-losses trigger simultaneously. They automatically become sell orders, which floods the market with supply and causes a cascading liquidation event. If that level breaks, the door is wide open to the short side.
Wow. And finally, let's look at crypto positioning, because the institutional data here is telling a story that actively contradicts the prevailing retail optimism.
We have to circle back to the very first thing we discussed: rising bond yields. High rates are a severe macroeconomic headwind for risk-on assets like Bitcoin and Ethereum.
Right.
When institutional capital can get 5% risk-free, they are far less likely to allocate to non-yielding digital assets.
And the commitment of traders' data proves this out. The sources show that commercial traders, the massive institutional players, currently hold a record net short position on Ethereum.
A record net short. They are aggressively betting against upward momentum.
So the actionable takeaway for crypto this week isn't to try and catch a falling knife or, predict a bottom. The sources emphasize waiting for undeniable technical breakouts to prove the trend has actually shifted.
Yes. For Bitcoin, that means a decisive weekly close above 70K. For Ethereum, you need to see it reclaim 2K.
Until those levels are broken, you are fighting a massive macroeconomic headwind and record institutional shorting.
It's just not worth the risk.
So with all of these binary, highly volatile events stacked on top of each other, a totally unpredictable Fed meeting, mega cap earnings that could reshape the AI narrative, and technical charts sitting on razor-thin supports, what is the actual mathematical edge for a trader this week? Is there a scenario where the smartest trade is to just sit on your hands and step away?
There is a very old adage in trading. Sometimes cash is a position.
Right.
When you have a massive macro catalyst like Kevin Warsh potentially shocking the bond market, technical support levels become completely irrelevant. A hawkish Fed surprise will slice through a quadruple bottom like a hot knife through butter.
That makes sense.
Your mathematical edge in a week governed by unpredictable binary events is often just capital preservation. Letting the dust settle, allowing the market to show its hand, and trading the confirmed trend next week, that is how professionals survive environments like this.
So to synthesize this massive pressure cooker we're navigating today, we have a shrinking pool of global savings driving the cost of capital to its highest levels in years. We have a multi-trillion-dollar AI capex bubble that the smart money is beginning to actively punish in favor of cash-flowing alternatives. And the entire equity market is teetering on a few key levels: 7496 on the S&P and 28700 on the Nasdaq-Q.
Map those levels out and respect the volatility.
Before we wrap up, I want to leave you with a final thought to mull over, expanding on what we've unpacked today regarding the AI capex cycle. We've talked about the billions being incinerated to build these massive foundational AI models.
Zillions and billions.
But what if AI models eventually become completely commoditized over the next 5 to 10 years?
Yeah.
Think about the telecom industry. 30 years ago, companies spent hundreds of billions laying fiber optic cables and building cell towers. But today, you as a consumer switch seamlessly between identical 5G networks based purely on who offers the cheapest monthly rate.
Right, the technology became a utility.
Exactly. So if open source models make AI just another cheap, interchangeable utility, what happens to the trillions of dollars currently baked into the valuations of the hyperscalers building them?
That's a great question.
Will the ultimate winners of the AI revolution actually be the non-AI companies? The boring traditional businesses that simply plug into these cheap, commoditized tools to completely slash their own operating costs, while the tech giants are left holding the massive infrastructure bills.
It's a fascinating paradigm shift to consider, especially as you watch these tech earnings roll in this week.
Definitely. Thank you for joining us on this deep dive. Map out your levels, protect your capital, and we will catch you next time.